Welcome back to the deep dive. So if you're tracking the AI industry right now, here in late 2025, you're not watching a software race anymore.
No,
You're watching what some are calling a hardened industrial phase.
that's the critical pivot.
This isn't a war fought with code on a laptop.
Yeah.
It's concrete, it's massive power grids, and it's custom silicon.
Exactly. The whole conversation has moved away from what these large language models can do, and it's landed squarely on infrastructure economics.
Right.
Specifically, what's the total cost of ownership for every single token you generate? This war is now about achieving what analysts are calling silicon sovereignty.
And that is the central tension we are unpacking today. We've got a really clear mission for this deep dive. We're going to break down whether these unbelievable amounts of capital that Nvidia and Microsoft are deploying into partners like OpenAI and Anthropic.
Billions and billions.
Is it really just a strategic defensive move against Google?
And our source material says yes. The thesis is not just valid, it's paramount. The market has definitively bifurcated, split into two very distinct models.
Okay, so what are the two sides?
Well, on one side, you have let's call it the traditional disintegrated Wintel-style alliance.
Okay.
You've got Microsoft providing the cloud and the cache, Nvidia providing the merchant silicon, and then the Model Labs OpenAI, Anthropic, they're the ones consuming the resources.
Now on the other side?
On the other side stands Alphabet's Google, and they are the definition of a fully vertically integrated sovereign ecosystem.
So they control the chip, the software, the whole stack.
The whole thing. And the most important piece of IP in this entire global contest, the one piece that poses a genuine existential threat to that whole alliance model, is Google's own internal silicon, their tensor processing unit, or TPU.
So that bespoke hardware.
Yeah.
That's what challenges this whole merchant silicon hegemony.
It's the core threat.
All right, let's start with the money, because this is where that vertical integration just seems lethal. Competitors like Microsoft, Meta, OpenAI, they're all operating under this huge financial burden that people are now just calling the Nvidia tax.
And we can't overstate how big this tax is. I mean, look, Nvidia's gross margins are in the range of 75 to 80% on their data center GPUs.
75 to 80.
The H100s, now the Blackwell series. So if you're Microsoft, that 75% margin Nvidia collects is just a sunk cost. It's profit leakage you cannot avoid.
But Google, they design the chips, they use them internally, so they just sidestep that 75% hit entirely.
Entirely. Industry analysis is pretty consistent on this. Because Google controls the whole stack, the design, the manufacturing, the integration. They get their AI compute at roughly 20% of the cost.
20%.
20% of what competitors pay on the open market. That's a 4 to 6 times cost efficiency advantage. It's not just a benefit, it's a strategic weapon. It completely changes the unit economics of AI.
A 4 to 6x advantage. I mean, that lets Google just aggressively undercut competitors on API pricing and still keep a healthy margin.
Or, and this is more likely, it lets them deploy vastly larger, more powerful models for search and their own internal services without totally destroying their profitability.
And that advantage just gets bigger as their custom ecosystem matures, right?
Yeah.
We're seeing new versions, the V7 Ironwood and V6 Trillium.
And they're designed differently. You see, Nvidia is all about packing maximum density onto a single chip. Google, on the other hand, prioritizes cluster scale throughput and power efficiency.
How do they even manage that kind of scale? They talk about this AI hypercomputer concept, like the whole data center is one giant chip. What makes that possible?
Okay, so this is where the technical jargon is actually crucial. They do it with something called optical circuit switching, or OCS.
Yeah. OCS.
Instead of traditional switches, OCS uses physical optics lasers and mirrors to dynamically reconfigure the whole network.
Like a train yard, instantly relaying tracks.
Perfect analogy. It lets them connect pods of maybe over 100,000 chips and make them act like a single coherent processing unit. It just crushes data bottlenecks. That's their hardware moat.
And for so long, the knock on TPUs was, sure, they're cheap, but can you actually train a frontier model on them?
That criticism is dead.
Gemini 3.0 changed that completely.
That was the watershed moment. It was trained entirely on TPUs. That single achievement just dispelled the whole notion that NVIDIA hardware was some kind of prerequisite for state-of-the-art performance. It validated a decade-long bet.
But wait, the hardware's only half of it. For years, the real lock-in wasn't just the chip. It was CUDA, NVIDIA's software stack. How did Google break that?
They fought software with more software. Their sustained investment in the JX framework and especially the XLA compiler, that's what made the difference.
The accelerated linear algebra compiler.
Right. And a compiler is basically a translator. It takes human code and turns it into machine instructions. By controlling XLA, Google created a viable and, for some things, a superior alternative to the whole PyTorch UDA stack. The software moat is now fundamentally permeable.
And you can't forget the chip that actually feeds the TPUs, the Axion CPU. This is Google's custom processor based on ARMv9. Why is ditching Intel or AMD so important strategically?
It's two things. First, you sever the final external payment. You get rid of the by86 tax, more cost savings.
Okay.
But more importantly, Axion is co-designed with the TPU. It uses their titanium offload system to manage data flow. So if the TPUs are these expensive engines, Axion will make sure they are never, ever sitting idle waiting for data. It's efficiency at every single layer.
It's just integration taken to the absolute extreme. It's genuinely sovereign infrastructure.
So when you're facing a competitor with a 4 to 6 times structural cost advantage, what do?
You can't compete on price.
You can't. Your immediate strategy is to lock down your customers and deploy capital defensively. And that is precisely what Microsoft and Nvidia are doing.
It's just an astronomical cash war, and it's built on what is, I think, the most controversial financial mechanism in tech right now. The circular economy. I mean, how sustainable is that? Doesn't it sound a lot like the vendor financing that blew up the dot-com bubble?
It does. There are really strong parallels to what we saw with, say, Cisco and Lucent in the late 90s. Back then, vendors would finance their own customers' purchases, book it as revenue, and watch the stock soar.
But the risk is that your balance sheet is just filled with debt that you're pretending is revenue.
Exactly.
So walk us through how this AI loop works today with Nvidia.
Okay. The mechanism is straightforward, but it's very effective. Nvidia invests cash. We're talking hundreds of millions, sometimes billions, into a strategic startup.
Like a CoreWeave or a Key Model Lab.
Right. That startup, which is now flush with cash, immediately signs an ironclad commitment to spend that money on Nvidia hardware.
Plus usually some debt financing that's secured by that investment.
Correct. So Nvidia gets credit for a smart venture investment, and they get to book the hardware sale as immediate revenue.
Which props up the income statement, justifies the huge valuation, and lets them do the whole cycle again.
You got it. The goal is twofold. One, you artificially sustain demand and pricing power. And two, you make sure these model labs stay captive. They stay optimized for your ecosystem. It buys you time. It delays the inevitable commoditization that's coming.
And this requires a massive balance sheet, which brings us to this NvidSoft alliance, this tense but symbiotic partnership between Microsoft and Nvidia.
It's a total marriage of convenience. Microsoft absolutely needs Nvidia chips right now for Azure, for Copilot, even as they're developing their own Maya chip in the background.
They need the capability now.
And Nvidia, in turn, needs Microsoft's enormous balance sheet to help fund and absorb these multi-billion-dollar chip buys that keep the circular economy spinning. They're totally intertwined to contain the Google threat.
I think the most powerful example of this defensive capital strategy has to be the joint $15 billion commitment they poured into Anthropic.
Oh, this is pure defense. That Anthropic investment didn't just come with a friendly suggestion to use Nvidia chips.
No.
The deal involves a direct commitment for Anthropic to purchase a staggering 1 gigawatt of compute capacity.
A gigawatt?
Powered exclusively by NVIDIA systems.
That's not a large order. That is infrastructural lock-in.
It's a defensive gigawatt lock-in. It immediately takes a huge chunk of the market off the table for competitors like Google's TPUs or Amazon's Trainium. It ensures Anthropic dedicates all of its planning, all of its software to NVIDIA's future architectures. It makes switching later exponentially more expensive.
So they're literally paying their customer not to switch to the competitor that has a 4 times cheaper solution.
That's the play.
Yeah.
But even while Microsoft and NVIDIA are building these defensive walls, the cracks are already starting to appear. The foundational shift we're seeing is the market fracturing away from these general-purpose high-margin GPUs.
And moving toward what?
Towards specialized ASICs,
Yes.
application-specific integrated circuits.
And the silent kingmaker in this whole transition. It isn't a household name, but it probably should be. Broadcom.
Broadcom, or AVGO, is effectively the architect of the anti-NVIDIA resistance. They don't make the headlines, but they are designing the custom chips, the XPUs, for all the big players. Google's TPU, Meta's MTIA, and, most critically,
OpenAI.
OpenAI.
Wait. NVIDIA's most public, most important customer is partnering with Broadcom to make their own chip. That That seems like the most damaging blow imaginable.
It's the ultimate signal of erosion. OpenAI deciding to partner with Broadcom for custom inference chips, which are slated for 2026. It signals that even their number one customer sees the Nvidia tax as unsustainable.
Especially for inference, which is where all the cost is.
90% of the cost is running the model, not training it. Exactly.
So if the biggest model labs can just run their models on custom silicon that Broadcom helps them build, what happens to NVIDIA's profits?
That is the core structural threat. Broadcom's success means Nvidia eventually has to compete on price, and that will compress those eye-watering 75% gross margins back toward historical semiconductor norms.
So 50 to 60%.
Probably. The pricing power that was tied to their monopoly it's eroding fast.
And this margin compression is tied to the manufacturing bottleneck at TSMC, right?
Yeah.
Specifically for this CoWoS packaging.
Correct. Chip on wafer on substrate. It's the advanced step needed to build these complex chips. And while Nvidia locked down the lion's share, about 60% of that capacity for 2025 and 2026, Broadcom and Google are eating into the rest.
Why would TSMC let them?
Because TSMC sees Broadcom as a strategic hedge. They want a healthy ASIC market so that no single customer, namely Nvidia, can have too much pricing power over them.
Okay, let's talk about Google's most aggressive move yet. They're pivoting. They're not just using TPUs internally anymore. They're selling or leasing them as on-prem hardware.
This is a seismic shift in the AI landscape.
A geopolitical shift.
It is. Google is turning a massive internal cost center, all that silicon R&D, into a high-margin external business. The reports that Meta is going to start integrating Google's TPUs into its data centers.
Starting in 2026 or 2027.
That is a catastrophic breach of NVIDIA's moat. Meta is one of the biggest chip spenders on the planet.
So Google is denying NVIDIA billions in future revenue from a core customer, while at the same time becoming a direct competitor, a kind of mini NVIDIA operating with that huge cost advantage.
That's exactly what's happening. So when we look at the financial outlook, late 2025, the structural split between the two camps, it leads to a really sharp divergence in how the street is valuing them.
For Alphabet, for GOGL, the bull case seems incredibly strong and maybe even underappreciated by the market right now. What are the catalysts?
Well, primarily massive margin expansion.
Right.
Every single workload Google shifts from an NVIDIA chip to an internal TPU. That's 75% of external margin they get to keep.
And second,
The new high-margin revenue from selling TPUs to customers like Meta. I mean, conservative estimates suggest this could be a $10 to $20 billion business by 2027.
and that's revenue the market currently assigns a value of, what, basically 0 to?
Near zero.
And Alphabet is priced at, what, 22 times forward earnings? It's still trading like an ad company. Nvidia is much higher.
Which suggests there's huge potential for multiple expansion. As the market starts to see Google as a structural AI hardware winner, not just an ad giant, its multiple should re-rate significantly higher. They own the cost structure of the next era of computing.
So conversely, what's the bear case, or maybe just the neutral case, for NVIDIA, for NVDA? They're priced for perfection, for uninterrupted exponential growth.
But those structural risks are mounting. There are three big ones. First,
Yeah.
what we've been talking about, the erosion of their competitive moat from ASICs.
Right.
Second is the potential for revenue to decelerate because the hyperscalers are hitting peak capex, Microsoft and Meta. They can't just increase their capital spending by 30% forever. They're reaching limits. When they pull back, NVIDIA's main growth engine stalls.
And the third risk,
Yeah.
the scariest one, is the unwinding of that circular revenue model. What happens when the startups they funded can't pay their debts, or when the market decides vendor financing isn't healthy growth anymore?
It creates a tremendous vulnerability. If a key customer defaults, or even just tries to renegotiate because there's a cheaper ASIC alternative, that whole structure of sustained demand and high pricing could just fracture. It would force their margins down almost instantly and cause a massive correction in their valuation.
And finally, what about the macro factors? Two really stand out, and they both seem to favor Google's approach. First is energy.
Absolutely. The move to gigawatt-scale data centers makes power efficiency the ultimate limiting factor. And TPUs, designed from day one to be liquid-cooled, they're just inherently more power efficient than general-purpose GPUs. It favors the low-cost, high-efficiency architecture.
And second, the elephant in the room, antitrust.
Nvidia is facing more and more scrutiny globally for its bundling practices, forcing customers to buy their networking gear to get GPUs, and of course, for the investment for sales tactics. If a regulator forces them to unbundle their products or restricts those investments, That could be the black swan event that completely derails their margin structure.
Okay, let's synthesize this deep dive. We've confirmed the central conclusion here. Nvidia and Microsoft are fighting an unprecedented defensive capital war.
Yeah.
And it's a war against a competitor, Google, that established a superior long-term cost structure through what we're calling silicon sovereignty.
The structural advantage is shifting. It's shifting fast. The future of AI doesn't belong to the general-purpose high-margin GPU. It belongs to domain-specific, vertically integrated, custom silicon.
Whether that's a TPU or a Broadcom-designed ASIC.
That 75% margin tax is actively being engineered out of the system as we speak.
And that brings us to the final provocative thought that our sources suggest we should leave you with. This whole silicon war is really about one thing: collapsing the cost of intelligence. So if the cost of generating one AI token drops by 4 times or 6 times because of Google's efficiency and the rise of ASICs, that intelligence essentially becomes a commodity.
It becomes cheap.
Abundant. So what happens to the economics of AI when its primary input cost just collapses? And which company stands to gain the most value in that world? The one that makes the now cheap silicon, or the one that controls the vast world of applications and services built on top of that cheap, ubiquitous intelligence?
That's the ultimate question.
And that is where we'll leave this deep dive.